Welcome to the Deep Dive, where we take your sources and really unpack them to find the crucial insights.
Hi there.
Today, we're diving into some key excerpts from a pretty hefty document, Wells Fargo's 2024 Form 10K annual report.
Yeah, the 10K. It's basically the company's detailed look back and roadmap forward, just packed with information.
Absolutely. So our mission today is to navigate this thing together, pull out the most important bits for you, the listener, so you can really understand Wells Fargo's business in 2024.
Exactly. We're talking its main business segments, how it performed financially, what it's doing for shareholders, and what it sees coming down the pike.
It can be dense. Right. So we're trying to make it accessible, like we're looking at this complex map together.
Let's do it.
Okay, so starting with the big picture, this report really underscores the scale. Wells Fargo is just enormous.
About $1.9 trillion in assets, a major player in the U.S. market.
Yeah, ranked fourth largest U.S. bank by assets, third by market value at the end of 24.
And that scale is kind of the foundation. To manage something that big, they break it down into four main reportable operating segments.
Right, this is how management sees the business.
Exactly. Consumer banking and lending, commercial banking, corporate and investment banking, and wealth and investment management. Understanding these four is really key.
Got it. So let's break down what the report told us about each one. Consumer banking and lending first. That covers a huge chunk of their customer base.
It does. And a major strategic focus for them here in 2024 was definitely the credit card business.
Ah, okay.
Yeah, they see it as a high return area, leverages their existing customer relationships, their infrastructure.
And the report shows they've been putting real money behind that, new products launching.
Yeah, 11 new cards since 2021. And specifically in 2024, 4 new consumer cards and 1 for small business.
And did that translate into growth?
It seems like it. They opened over 2.4 million new credit card accounts just in 2024.
Wow, 2.4 million. That's significant scale. And the report made a point of saying they did this while maintaining their credit standards.
Crucial point, yeah.
Yeah.
Especially when you're growing fast. They also mentioned, continuing to work on customer service platforms, especially maybe linking things better for affluent customers who might use wealth management too.
Okay. And what about the overall loan trends within that consumer segment?
So overall, consumer loans were actually down slightly, about 3%,
Okay. And why was that?
mainly driven by lower balances in residential mortgages and auto loans. Basically, people paying down loans faster than new ones were originated.
But credit cards were the exception.
Exactly. Credit card loans increased thanks to higher spending, point of sale volume, and those new products gaining traction.
So a bit of a shift in the mix there. Did they mention delinquency rates?
They did.
Yeah.
And you can sort of see some broader economic pressure reflected here. Home lending delinquencies actually improved a bit.
Yep.
But credit cards, 30-day plus delinquencies rose to 2.91%, and the more serious 90-day plus ones hit 1.51% by year end. So that growth came with a bit more risk bubbling up.
Right, that credit card delinquency number, 1.51% in 90-day plus, that definitely catches the eye. Okay, moving to commercial banking, who are their main clients here?
This is where they serve private companies, family-owned businesses, some public companies too, offering things like standard banking, credit lines, secured lending, leasing, treasury management.
And the report flagged a specific challenge here.
Yeah, an increase in what they call internally criticized commercial and industrial loans, or C&I loans. That portfolio grew from $14.6 billion up to $16.5 billion.
Okay, $1.9 billion increase. Did they say why?
They did get specific, said the increase was primarily in loans to companies in entertainment and recreation, and also equipment, machinery, and parts manufacturing.
Interesting. So specific sectors feeling some pressure there.
Exactly. It shows that even within that big commercial book, things aren't uniform.
Okay. Let's shift gears then to corporate and investment banking, CIB. This often reflects what's happening in the capital markets. How did it fare in 2024?
CIB had a strong year, especially investment banking fees. That revenue line jumped significantly.
How much?
From $1.6 billion in 2023 up to $2.7 billion in 2024.
Wow. Okay, that's a huge leap, over $1 billion increase.
Yeah. And they attributed directly to market share gains in debt and equity capital markets, plus more M&A advisory work.
So more deals, bigger role in them.
And they gave a really powerful example to illustrate this, the Quikrete Company's acquisition of Summit Materials, a huge $11.5 billion deal.
Okay.
Wells Fargo wasn't just a bank on the deal, they were the exclusive financial advisor to Quikrete. And maybe even more impressively, the sole underwriter for the $10.7 billion financing package.
Sole underwriter for nearly $11 billion. That's massive.
It is. The report called it one of the largest non-investment grade commitments ever by a single bank. And the deal itself. Largest cash acquisition in U.S. construction materials history.
So for you, the listener, this one deal really paints a picture, doesn't it? It shows the kind of scale and resources Wells Fargo can deploy for major clients and how important those relationships are for winning that kind of business.
Absolutely a very vivid example of their clout in that space. Okay, last segment. Wealth and Investment Management. WIM.
Right. What's the core business there?
Pretty straightforward. Investment advice, brokerage services, trust services, mostly for individuals and families.
And what drove revenue growth here in 2024?
Two main things. Higher asset-based fees.
Which makes sense, right? Markets were generally up in 2024, so the value of assets they manage increased, and their fees are often tied to that.
Exactly. And the second driver was higher commissions and brokerage fees. Basically, more clients were making trades, generating more transaction revenue.
Got it. So that gives us a good feel for the four main engines driving the Wells Fargo business. Now maybe let's zoom out. Look at the overall financial picture from the report.
Okay. A key profitability metric they always discuss is return on average assets, ROA. It basically shows how well they're using their assets to make profit.
And how did that look?
It ticked up slightly, from 1.02% in 2023 to 1.03% in 2024. So marginal improvement, but moving in the right direction.
Okay. And looking at the top line, revenue, that comes from net interest income and non-interest income. What did the report say about those?
Well, net interest income, the difference between what they earn on loans and pay on deposits, was impacted by various things like changes in loan and deposit balances,
Yeah.
funding costs, kind of the usual moving parts for a bank.
Right. And the non-interest income side, the fees and other stuff.
That's where we saw some of those highlights we already touched on. The big jump in investment banking fees, also increases in wealth management fees, like we just said. And interestingly, mortgage banking income was up too.
Oh, even with mortgage volumes maybe being a bit soft.
Yeah, partly from selling commercial mortgage loans they had securitized, and also managing the value and risk of their mortgage servicing rights, their MSRs. Plus, they noted higher net gains from trading activities, foreign exchange, structured products. So a pretty diverse mix feeding into that non-interest income line.
Okay. What about the expense side? Did those efficiency initiatives they mentioned actually show up?
They did. The report points to lower personnel expenses. That includes severance costs from reducing headcount, and also lower spending on things like consultants, professional services. So yes, some cost savings were realized.
Well, there's always a but, isn't there?
Well, yeah. Those savings were significantly offset by higher operating losses.
Okay, how much higher?
Operating losses jumped from $1.18 billion in 2023 to $1.76 billion in 2024.
Oof, that's a noticeable increase. What drove that?
The report breaks it down. Higher legal accruals going from $179 million up to $290 million. But the really big jump was in customer remediation costs.
Making customers whole for past issues.
Exactly. Those costs went from $207 million in 2023 to $722 million in 2024. Nearly quadrupled.
Wow. So for you listening, that's a really stark reminder. Even as they try to move forward, the financial hangover from past conduct, especially the cost of fixing things for customers, is still a major drag on their bottom line.
It really is. It definitely dampens the impact of those efficiency gains.
Okay. Switching over to the balance sheet quickly. Any key movements there?
Well, we mentioned overall loans were down slightly, 3%. Total equity also dipped a bit, down 4%. Long-term debt saw a bigger reduction, down 17%.
And deposits?
Total deposits were pretty flat overall. But interestingly, within commercial banking, deposits were up 22%.
Suggests maybe their corporate clients were holding more cash?
Could be. Yeah, that's a notable shift within the overall flat number.
Okay. Let's talk provision for credit losses. This is the money they set aside each quarter, basically, to cover expected future loan losses.
That's right. It feeds into the overall allowance for credit losses, the ACL, which is the total reserve sitting on the balance sheet. End of 2024, that ACL was $14.6 billion.
And they feel that's adequate.
They state they believe it's sufficient for expected losses. Now, the actual provision expense that hit the income statement was lower in 2024 than 2023, $4.3 billion versus $5.4 billion.
Okay, so they set aside less money in 24. Does that mean credit quality dramatically improved?
Not exactly. The report clarifies it was a mixed bag. That lower provision actually reflected higher actual loan write-offs, net charge-offs, primarily driven by that credit card activity you discussed.
Right, the growth and higher delinquencies there.
Yes. But that was offset by a decrease in the allowance they needed specifically for commercial real estate or CRE loans. So less perceived risk in CRE helped lower the overall provision, even as credit card losses went up.
And how do they decide how much allowance they need?
It's heavily based on economic forecasts, what they expect for unemployment, GDP growth, property prices, things like that. Changes in the economic outlook directly flow through to that allowance calculation.
Makes sense. And just briefly on cash flows.
Net income itself was up slightly, $19.9 billion in 2024 from $19.0 billion in 2023. Key adjustments in the operating cash flow section included adding back that non-cash provision expense and changes in the value of those mortgage servicing rights.
Okay, so we've got the structure, the financial results. Let's talk about shareholder value. How does Wells Fargo return value beyond just earning profit?
Well, the two main ways for a big bank like this are dividends, paying cash out directly, and share repurchases, buying back their own stock.
Right, buybacks. And the report gave some pretty solid numbers on that activity.
They did.
Yeah.
They bought back a lot of shares in 2024, 332.8 million shares.
And that follows quite a bit in the previous years, too.
Yep, 272.1 million shares in 2023 and 110.4 million in 2022. So it's been a consistent effort. And doing that reduces the total number of shares outstanding, which helps boost metrics like earnings per share for the remaining shareholders.
But the decision on how much to buy back isn't simple, right?
Not at all. The report stresses it depends on many things. Their earnings, obviously, their capital levels, and this is huge, meeting regulatory requirements, especially around stress tests. Market conditions play a role, and just general regulatory comfort levels.
Yeah, let's talk about that regulation piece. The report spends a lot of time on regulatory capital. For you, the listener, trying to grasp what shapes a bank's strategy, this isn't just jargon, it's fundamental.
Absolutely fundamental. These rules dictate so much. They talk about the Common Equity Tier 1 ratio, CET1. It's a core measure of financial strength versus risk-weighted assets.
Okay.
Then there's the GSIB surcharge. Because Wells Fargo is a global systemically important bank, they have to hold extra capital.
Yeah.
For them, that surcharge is 1.50%.
An extra buffer just for being big and interconnected.
Pretty much. And then the stress capital buffer, the SCB, that's another add-on determined by how they perform in the Fed's stress tests. Theirs is 3.80% under the main approach.
And they mentioned TLAC, too. Total loss absorbing capacity.
Right. Another requirement ensuring they have enough resources to handle failure without taxpayer bailouts. So understanding these different capital layers is key. They directly impact how much risk the bank can take on, how much it can lend, and importantly, how much capital it has left over to return to shareholders via those buybacks or dividends.
Especially for Wells Fargo, given its past regulatory issues, staying well above these minimums is probably not just required, but a strategic imperative to show progress.
Precisely. It's a constant balancing act. These requirements shape decisions daily. Looking ahead, the report also lays out the key risks they see on the horizon.
Always important. What are the big ones?
Well, economic and market conditions. Naturally, a downturn could hurt loan demand, push up credit losses like we saw hints of in credit cards, and dampen fee income from things like M&A or wealth management.
And interest rates. Always a factor for banks.
Huge factor. Changes impact their net interest income, obviously.
Yeah.
But also the value of assets, like those mortgage servicing rights. It cuts both ways.
What else?
Operational and security risks are high on the list. Things like system outages, cyber attacks are a constant threat, risks from third-party vendors they use, and they even mention risks emerging from artificial intelligence.
AI threats. That's definitely contemporary. And legal and regulatory risks. Still a factor.
Oh, absolutely. Potential lawsuits, ongoing regulatory scrutiny, and those customer remediation costs we saw spike in 2024, that remains a big area of uncertainty.
Did they quantify the potential legal exposure?
They provided an estimate. They said the range of reasonably possible legal losses above what they've already accrued was around $2 billion at the end of 2024. But they stress, these things are highly unpredictable.
Right. $2 billion is still a significant potential number hanging out there. Any other major risks mentioned?
They specifically called out the mortgage business again, just noting its inherent volatility tied to interest rates and their reliance on government-sponsored entities, Fannie Mae and Freddie Mac, buying their loans.
Okay. So wrapping it up, the picture moving forward seems to be one of navigating all these complex risks, meeting those tough regulatory hurdles while still trying to execute on growth in areas like credit cards and CIB.
That's the challenge, isn't it? It's a constant tightrope walk. Manage the risks, satisfy the regulators, and deliver profitable growth and shareholder value.
So this deep dive into the 10K really gave us a window into that. We saw the segment mix, the financial drivers, both the good, like CIB fees, and the challenging, like those operating losses and remediation costs. We saw the focus on shareholder returns via buybacks, and crucially, how much the regulatory environment and ongoing risks shape everything.
It really does lay bare just how complex running a giant bank is today. And maybe a final thought for you, the listener, to mull over. When you look at a company like Wells Fargo through this lens, how do you weigh the successes, the strategic wins like the Quikrete deal or the credit card growth? How do you balance that against the inherent risks they face and the very real ongoing costs tied to their operating environment and past issues? What part of that whole picture feels most critical to you in judging their future?
Definitely something to think about. That's all the time we have for this deep dive. Thanks for joining us.